YouTubers, Mike Martin's here, Mike Martin's channel, man. I got a really pressing article for you guys, and a lot of people said they wouldn't raise rates because if they raised rates, a lot of people couldn't afford their mortgages. Well, it's happening, and it's happening in Canada. Royal Bank, TD, raised their fixed 5-year mortgage rates. So what's going on here, people? Let's take a look. Canada's two largest banks have raised their interest rates to their benchmark 5-year mortgage, and more are expected to follow. The Royal Bank of Canada raised the posted rate for 5-year fixed-rate mortgage by 15 points, or whatever you want to say it, to 5.14%. The bank confirmed that the CBC news in an email. Okay. Shortly after, Toronto Dominion Bank did the same, watching Royal Bank's new rate. So they're all looking at each other, kind of, even though they're all in the same melting pot, right? Canada, other three major banks, Scotiabank and Bank of Montreal and CIBC, currently have 5-year posted rates of 4.99%. But they are also expected to hike soon, based on what's happening in the bond market. Scotiabank says it's reviewing its rates and will likely soon make changes. Banks finance their mortgage via a variety of sources, but the main one is by selling bonds, which they use to raise funds and then lend that money out to home buyers and other borrowers. So it's through the bond. That's what they say, right? Rates in the bond market have been inching steadily higher, which raises the bank's cost of doing business. The annual yield of a 5-year bond from the Canadian government briefly topped at 2% this week, the first time it's been that high since 2013. 2-year government bond yields also spiked 1.8%, their highest since 2011. I remember that, actually. I actually remember that. Variable rate mortgages. Higher mortgage costs for the banks point to potential upside for fixed mortgage rates. By Bank of Montreal economist Robert Kovic said in a note to clients yesterday, even if a borrower can't negotiate a better rate than the bank's posted rate, the posted rate is what the Bank of Canada tabulates is the benchmark rate from. And that is one of the two options for the new stress test rules and other... Hold on a sec. Let me just... So my camera goes in and out here. Rules and other being test their finances at 2 full percentage points above the actual rate. That means would-be buyers would have their finances tested though their mortgage rate was the new 5-year levels. And they fail the test, they won't qualify for the loan. Well, I mean, that's how it works, right? Higher rates on fixed mortgage rates come at a time when the Bank of Canada is widely expected to raise its benchmark interest rates next week. Fixed-rate mortgages are tied to activity in the bond market, but variable rate mortgages are closely linked to the Bank of Canada's rate. So, a higher central bank rate means variable borrowers should expect a higher cost soon too. Now, I don't know if you guys remember, I've been talking about these variable rate mortgages, how very dangerous they are, especially in a volatile, when this interest rates are starting to go up. Everyone's been watching this party going on for I don't know how many years with these low interest rates and free money. And in a very normal housing market in a different dimension, 5% is normal. So if you're borrowing $100,000, it roughly cost you $5,000 to $6,000 a year in finance charges. If you have $200,000, you're looking at about $10,000 to $11,000. If you have $300,000, then you're looking at about $16,900 to $17,500 in finance charges. You have $400,000, but the typical house in Vancouver is like $1.4 million. So a lot of people are leveraged to the teeth. And I think this is going to be a huge problem for a lot of people paying their mortgages back. I don't want to see people fail. I don't want to see people, doing bad. I don't want to see people struggle. It's something that a lot of people jumped on, and I just feel the houses are not worth what they are. And the average Canadian, with the wages they're making, a dual family income, a 6-figure income, with a low six-figure income. And I said this, and I've read articles to prove it. The average house should be $300,000 to $400,000 after finance charges. When you factor in the finance charges on a low six-figure income, you factor in the finance charges, you factor in the cost of living, food, you factor in all these other bonus bills, your $200 stupid cell phone bill, you start factoring in that, gasoline, price hikes, food hikes, Yeah, you need 100 grand a year just to live a basic life if you want to own a house. And you're not owning a house more than $400,000 if you're making $100,000. You know what I'm trying to say? A year. So a lot of people are in the comments are always destroying me, saying, "Oh, Mike, why do you think a house is only worth $400,000?" Well, yeah, I bought mine for $260, and you got to see my house in the videos. Anyways, let me know what you guys think. What is happening? Why is this happening? It has to happen. I'm really sorry, but you know what I'm saying? Look at the articles, see what's going on. I think this whole mortgage thing is going to be a rude awakening for a lot of people, and a lot of people that are waking up to this right now are playing the "I didn't know this is going to happen," and then there's tons of lawsuits flying around all over the place right now out in Ontario. So I want to know what you guys think. Comment below, and don't forget to hit the subscribe button.